Good evening, everyone. Thank you for coming to today's investment discussion group. Before I start, let me first introduce the speaker, Kristen Jacks. Kristen Jacks is a financial educator and the founder of Money in Your 20s. Kristen studied financial planning at the Boston University Center for Professional Education. She started her career at Kiplinger's Personal Finance magazine and later worked at the Mutual Fund magazine. Kristen is a graduate from Duke University. Today, Kristen will talk about how to read financial statement with fun. Hey, Kristen, you can take over the screen now. Thank you.
Great. Thank you, Young. Can you hear me clearly?
Yes, very well.
Oh, perfect. Well, welcome everybody, and a big thank you to Greenwich Library. They do a wonderful job, paying for speakers that deliver really impactful information. Hopefully you will find this super packed with relevant data for you, and it will be fun. I mean, that's kind of the thing I most try to do, is keep things lively, make examples relevant to your life, and I shy away from jargon as much as humanly possible. So welcome to Fun with Financial Statements. Before we get started, in case you missed it, and I'm not going to reveal my age, but I only recently found out that ICYMI, that's in case you missed it. So now I'm trying to use it like I know what I'm doing. But our last session, the tax consequences of investing, was such a fantastic session. We covered really important topics. I had so many people reach out to me afterward and say that they learned something that they never knew. And these are active investors. Like, I think the number one thing was people did not know that gold does not get taxed. Like if you make a gain in gold, it's not taxed like other familiar assets like stocks and bonds. And it's actually a much more punitive tax. So unusually, this is unusual for us, the tax consequences of investing is on the library's YouTube channel. And if you don't know how to find that, you can always email me and I'll email you the link, or you can email Young Wong and she'll email you the link. But it really ended up being a fantastic program. And the other thing we kind of found out is, progressive taxation, how our tax system works. You really can't delve too far into investing and really understand the tax consequences of investing if you don't fully understand progressive taxation and how our tax system works on your ordinary income. Because if you sell, an asset after purchasing it, and if you buy it and sell it in less than 1 year, then you're taxed at ordinary income rates. And then in that case, you really need to understand your tax bracket to understand if you're making a big mistake by selling in less than a year, or actually, maybe your income isn't so high, so it's not that big a deal. You're not in a very high tax bracket. But if there's any chance anyone listening doesn't fundamentally understand exactly how our tax system works, there's a chapter of my book that I give out free to anybody who wants it. It's called Taxes 101, and that's really the prerequisite for a lot of what we do in investing. It has such a tremendous impact. And when I write things that are very clear. I try to be funny. They're super straightforward. I give everyday examples. So if you would like that chapter, you can just email me, kjacks@moneyinyour20s.com. So that's just in case you missed it. Okay, fun with financial statements. You can do this. There are some people out there who are looking at this horrible page and seeing terms they don't recognize, seeing a ton of numbers. And I'm a numbers person. I actually love math. But for somebody who doesn't like math, this is already like a no-go. This looks terrible. This looks like something you definitely want to avoid. Can you avoid it? No. If you're really going to be at all even like, a slightly accomplished investor, you have to be ready to do your due diligence when it comes to investing in stocks. So you have to be able to look at something like this. Warren Buffett, who's arguably one of the most famous investors, says no one should buy an individual stock, if they haven't actually looked at these financial statements. So we have to do this. You can do this, and it's not as horrible as it seems. So I just want to remind people out there that there are things that, you probably consider fun, like playing golf, where a typical scorecard for golf, to me, looks more complicated than any financial statement I've ever seen. So this is a typical scorecard for golf that, when it was first handed to me, I wouldn't have understood it at all. I don't understand the terms. I don't understand the numbers, but people have fun playing golf every day. And, when there's fun involved, they get past the things that look off-putting, and they just get it. And you will get it too. Young, can you mute everyone except for me because there's some funky background noise? Young?
Yes, I muted everyone. Okay, there's
okay.
one more. I'll mute.
Okay, perfect. All right. And if golf is not your thing, a typical family game that you probably learned growing up, Yahtzee, just try to remember when you first saw all of those numbers and all of those terms you didn't recognize, like, the small straight and the full house and all the numbers and things like that. It was very off-putting. So, if you can play Yahtzee, if you can play golf, you can learn financial statements, and all of these numbers and new terms will actually fall into place, and they will be fun. So a few guidelines when you're trying to learn things that are very confusing. Definitely expect, that there's going to be a new vocabulary. Every specialty has its own vocabulary. And also, we'll just take things in small, digestible amounts. Don't just look at one huge, page of a balance sheet or a statement of cash flows, and your head will start to swim. So we'll break it down. And just so you know, finance in particular, the language behind it can be really off-putting. And there's a guy, John Lanchester, who wrote a great book where he really outed the financial community. The financial community takes things to an extreme where they're using terms that might seem familiar to you in a way that doesn't relate to everyday language at all, to the point that it's unfair. I mean, securities are not secure. Hedge funds don't hedge anything. Equity has nothing to do with being equal or fair. So, just don't infer when it comes to financial language. I have, my handy dandy financial dictionary with me. The internet makes it so easy. Anytime you look up a definition, probably it'll take you to Investopedia or one of these sites and give you like kind of the financial view of a term. But don't infer. Google. You're not going to recognize everything. And by the way, a lot of things you probably don't even need to recognize. I mean, this is a little due diligence of looking into financial statements, and you don't have to actually know every term. Okay. And then the other antidote is obviously to, take things in small amounts. So the large, part of the full page looks unbearable, but when you zoom in and you take a piece of it, like this current asset, so this is an example of a balance sheet, and you start looking at it and you're like, well, of course I understand, that a company has assets and, the company has cash. It has receivables, meaning that the company owes them money, so money is going to be coming in. Young, as people come, can you mute them so that
Yes, I muted everyone here.
Oh, now there's someone just, I think I can see one who's not muted, but okay, perfect. Anyway, so before we start though, why do we even have financial statements? Why do we have the balance sheet, the income statement, and the statement of cash flows? They're definitely giving you the full picture of a company, but why do we have them? Why do they even exist? And they actually exist for your protection, because after the 1929 stock market crash and then the subsequent Great Depression, the lawmakers in the United States were trying to figure out how can we make sure that level of despair for everyone, that level of loss in the stock market never happens again. And so the lawmakers put through the Securities Act of 1933, and the Security Act of 1934. They created the Securities and Exchange Commission. And this is right from the Securities and Exchange Commission website. The main purpose of these laws was so that any company that's trying to list a stock, any company that's offering a security for sale to the public must tell the truth about their business. This is your chance to take a deep dive into a company, and they have to tell the truth. The officers of the company can get fined, they can go to jail, very bad things can happen if they don't reveal exactly what's happening at the company in terms of assets and liabilities and how they did with their profit and loss and all of these things. They actually have to report these things. And that's, why the SEC is there, making sure that this is happening, making sure that investors are protected and that the markets are efficient and orderly, all those things. So financial statements are there to protect you. They discourage fraud. They don't stop bubbles. When a stock races up and is sort of mimicking the behavior of a bubble, that has nothing to do with the financial statements. That's when behavioral economics, behavioral psychology takes over and greed takes over and all those things. So that's not what the financial statements are doing. So some of the short-term action when a stock just takes off like a GameStop, there's a whole other story there. But in general, when you're investing for the long term, these financial statements are there to help you make decisions for the long term. And the one way I like to think about it is really just thinking of it like dating, right? So if you think of these companies like Disney or Starbucks or General Motors, these companies are able to hire the best marketers coming out of the best schools in the country. And these marketers make everything look great, right? They know the best photographers and designers, and they know the best copywriters that wordsmith everything and make everything sound fantastic. And that's, advertising and marketing. That's not what you're looking for. I mean, you're going to fall in love with, even the smells at Starbucks are amazing. But what if you could get past the external good looks and sort of the fun factor and really drill down into the things that are important? Just like dating, it would be, let's see. Hello. So like, what would help you invest, right, in dating? So you're on a date and it's all exciting, but what do you really know about this person? Imagine, and it doesn't have to be the first date, you don't have to be that nosy, but imagine if you really had access to true data about this person's credit score, their college transcript, their employment history. You don't have to be so calculating or cold-hearted, but at the end of the day, you could maybe eliminate the ones that are just going to be a mess. And that's a great use of financial statements. Like if you're looking at these companies, you don't want to fall in love with the marketing, the buzz, the rumor mill. You want to know, do they have revenues? And are the revenues growing? Do they have profits? They have revenues, but not profits. That's a key piece of information. Maybe they're not running the company correctly. What if the profits are not growing year after year after year? So much of a company's stock price is having that profit grow, being a growth stock. How do they handle their cash? I mean, maybe they look very good on paper. There are accounting rules that can make you look good on paper, but do they have free cash flow? What's the trend? What are the risk factors? These are all of the things that have to be disclosed in financial statements. And it was one of my favorite quotes from Peter Lynch, who's one of the most famous money managers of all time. And he says, people are very careful when they buy a dishwasher, they'll do a ton of research, but they'll put $10,000 on some stock they heard of on a bus, right? So this happens all the time. People don't do their due diligence, but it's also an opportunity for you, because if you're going to really look at the fundamentals, then you have an edge. Okay, so there's the annual report, and inside the annual report, you have the financial statements we're gonna look at. But outside of the annual report, anytime you can go online and you can go to like Yahoo Finance or Bloomberg or all these places and just look at a stock screen. And why isn't that enough? I'm just going to take a quick look at the chat, because it seems to be 6 things in the chat, and I just want to make sure we're not missing anything. Let's see. I muted everyone. Okay. That's weird. So I guess one person can't hear me, and I'm not sure why. I'm sorry. If a lot of you can't hear, then definitely speak up, but hopefully it's just one. And it is being taped, so that is a backup. Okay, so why isn't a stock screen enough? Well, a stock screen is great, and it's very valuable, and there are a lot of people who primarily use stock screens because they are day traders and they're more short term and they really want to just look at momentum and price action. They want to see, where was the stock last month? What's the 200-day moving average of the price? Very price based. What is the actual stock price? And then this stock screen has very important things like the PE ratio. So, that's very, very, very important. But what an annual report will do for you is giving you a real view into how a company is run. And they're going to show you things like the debt load of the company. And that is a hugely important piece of information. So you will never see debt load on a stock screen. You can also see this trend data of say a company really relies on selling products and then their inventories are building. You're going to see like a 3-year snapshot and you see that they have assets, but those assets are actually just inventories, and those inventories are getting bloated and bigger. That could be, a real red flag of maybe this company created some inventory that they're never going to sell, or they're never going to sell at a good price. Why are these inventories growing? So there are certain things that people do when they look at financial statements where they're looking for red flags. And, I think primarily people are looking to eliminate options because there are so many stocks out there. So a stock screen is great price action, but doesn't tell you enough. Okay. So we're almost there. We're going to talk about the balance sheet, the income statement, and the statement of cash flows. So those are the 3 primary financial statements that you see in every annual report. And the balance sheet, I want you to think of it as, in a lot of these situations, to get used to the idea, if you're really unfamiliar, you can think of your own household, or if you're just starting out, maybe think of a much more mature household, or maybe think of one of the most, affluent families, and how for them, a balance sheet would be a look at all of the things they own, all of their assets, their house, their cars, their jewelry, their clothes, all of those assets listed out, their furniture, all that stuff. And then looking at their liabilities. So maybe they have car loans, maybe they have a mortgage on their house, and maybe their kids have student loans. If you take a family snapshot, the balance sheet is going to show you assets and it's going to show you liabilities. And what makes it balanced is that it's not that assets purely equal liabilities, but once you're done, you have your assets and you're comparing them to your liabilities, wherever you kind of are done with your liabilities and you still have more assets, that difference is the equity. So that's, the equity that people talk about, the equity they have in their home, or maybe their total savings is a way to think of it. So the balance sheet is going to show you all of the assets, all of the liabilities, and then the remaining equity. An income statement is very different. An income statement is really just showing you a snapshot for a year of how that company is making money. It's their profit and loss. And it's really looking at the lifeblood of the company. And, very different from a balance sheet, because a balance sheet is all these accumulated assets and liabilities. But an income statement is a snapshot of 1 year and looking at profit and loss, and, and hopefully profit. You definitely want to steer clear of companies that are struggling to be profitable. And then finally, the statement of cash flows, I think, is the least understood of all of the statements, and people kind of gloss over it, but it's crucially important, because if managers of the company are not managing the company well and they're making mistakes, maybe purchasing too much equipment or spending too much in certain areas, it doesn't matter how profitable the company is. If management's making mistakes with cash, then they're flirting with bankruptcy, and they're really flirting with game over, because you have to be able to pay your salaries and your taxes, and you have to be able to pay for your raw goods and all these things. So the statement of cash flows is something that really helps people see the flow of cash into and out of the business, and just make sure that management knows what it's doing. Okay, so here we go. Looks terrible, the balance sheet, but we're going to zero in. We're just going to take pieces. And when you look at the balance sheet, which we're saying is like the closest to like a net worth statement, again, you could think of a small business or a family where, I mean, if you walk into the bagel shop in on the avenue in Old Greenwich, you walk into the bagel shop, you obviously see that they have furniture, they have lots of raw materials, you know, they have lots of inventory, they have lots of flour and yeast and oil and all these things. So you're in a balance sheet, you're going to look at all of the assets, and you're going to look at all of the liabilities, and then anything that, when you take the assets and compare them to the liabilities, the excess is what's called shareholder equity. And it's just equity, right? It's just the excess of, you know, liability. It's assets minus liabilities. So here we're going to zero in. I'm going to just show you, there like basically three pieces. We're going to look at assets, we're going to look at liabilities, and we're going to look at shareholder equity. And these formulas are, you know, assets are the liabilities plus the shareholder equity. Another way to think of that is, you know, what is equity? That's basically like the value, the overall value the company has created is assets minus liabilities. And if you're a family or a person, that's net worth, right? So you're really looking over years and years and years and years of the life of a company. They've accumulated, hopefully, a lot of assets, some liabilities, and a lot of shareholder equity. All right, so we've got current assets. And when you're looking at a business, it just makes sense, right? Businesses have cash. Hopefully businesses have cash because they have to have a nice cash cushion. You never know what could go wrong. I mean, COVID was a horrific, you know, a horrific setback for companies, but, you know, hopefully you're not dealing with things that are that dire, but things can go wrong. And so you have to have cash on hand to keep, you know, consistently paying your employees, even if business slows down, paying your rent obligations, paying, you know, to make the inventories that you plan to sell for the next season, all those things. You have to have cash. Receivables, that's just the money that's owed to the business because they sold something on credit, right? So not all the time, you know, when a business sells something, they don't necessarily immediately receive the payment. They can extend credit to, if they have consistent customers, those customers can buy on credit. A company will also have inventories, right? They will have created inventories. And since this is Krispy Kreme, I'm assuming they are not donuts, not the actual donuts, but the raw materials, right? So that, you know, Krispy Kreme is buying a lot of flour, and it's buying a lot of sugar, and it's buying a lot of the things that will go into making the donuts, and it's buying a lot of coffee, and it's buying a lot of coffee cups, and it's buying a lot of napkins and all of those things. So it makes perfect sense that this is a business where you're going to see, you know, those items, right? And what else? Property and equipment, right? So any company that's going to, you know, I personally have no idea how donuts are made, but I've seen videos of, like, you know, enormous vats of oil that the oil's bubbling. And, you know, I'm sure that the heating mechanism is very unique. I'm sure the vat itself is some top of the line, you know, some really well-tested product that is expensive to purchase. So we can imagine that a company has to invest in the property that makes these donuts and things like that. And also property, like the actual storefront is property. Now, a lot of times with this particular case with Krispy Kreme, they are leasing property. So they have more lease obligations than actually owning land outright. So you'll see a lot of, you know, leasing as an asset, but also as a liability. Another thing we're zeroing in on is something called goodwill, and that can be kind of confusing, but it's a neat concept. And the way I like to think of it is, if you think of brands that you just absolutely love, right? They have a premium connected to them. There's a value beyond, you know, like if you went to the Starbucks in town, say the Starbucks in town was this beloved, you know, coffee store, and say there was just one of them. Well, the value of that coffee store, if somebody was going to buy just that store, is more than the value of, like, the storefront and the inventory that's in there and access to the workers and things like that. There's this brand value that, you know, say you could add up all of the value of the store and maybe it's only $2 million, but somebody would pay $5 million for that store. And the difference in the price is this intangible called goodwill, that the brand and the promise of the brand and how you can sort of forecast future revenues because people just love going to a Starbucks. That's goodwill. And it actually sits as an asset on the balance sheet. And it can seem very confusing because it's not tangible. You can't touch it. And it's not perfectly measurable. It's somewhat subjective. But you'll find it all the time on a balance sheet. And it's really kind of getting into the value of the brand itself. I'm just going to take a quick look at the chat. How is the value of goodwill calculated? So companies have different methods. The easiest thing in the world, obviously, is if you have like a mature company and it has a book value and all of the assets, like say you have a mature company and all of the assets are listed, and then that company gets sold, and you can see how much it's sold for above just the straight book value. Like that's a very easy way to calculate goodwill. How goodwill is calculated in a company that's just started out, if you read the fine print in this annual report, which I have done because I'm fascinated by this question too, they really talk about sort of their metrics of what is normal, like what would be kind of normal sales versus what's the premium that they can charge all the way out into the future, and then the cash flows discounted back, specifically because they are a Krispy Kreme. So it's really getting into this brand value, and it's complicated, but probably the only reason you want to know is if you see something that seems out of whack. If you're looking at a balance sheet and the goodwill is some tremendous number that doesn't seem to really be merited, then you could say, I don't trust how this company is doing this. I think it's kind of suspicious. But in any case, you're going to see goodwill a lot. It has a lot to do with just the value beyond the actual, this furniture is worth this storefront is worth that, these employees in some sense are worth this. So it's really getting beyond the book value to this other value that people are willing to pay so much more because of the brand. Okay, so we have our current assets, and I think we've covered them. That's great. So current assets should make sense. Now we're going to look at our liabilities. And, Krispy Kreme is actually a very, very simple, straightforward company. There are much more complicated balance sheets, but we're just trying to take it easy. So it makes sense. When they talk about current assets, one thing to note is that just means something that, could be basically, if it's a current asset or a current liability, it really means something that has a life of less than 1 year, right? So versus like a long-term debt, like if you take out a loan and you don't have to pay it back for 5 years, that's a long-term liability. But if you just have receivables, where your customers owe you money, they all have to pay that, within 30 days, 60 days, worst case, 90 days. So that's called current because it's all coming in within less than a year. And your liabilities are all the things you're going to pay out in less than a year. So that's why you see the word current over and over again. And a balance sheet goes from, to the most current to the least current, or the most liquid to the least liquid. And then here it's funny because Krispy Kreme is such a small company with so few items on its balance sheet that they don't really even call out like long-term assets. In more complex companies, you'll see current assets and they're all listed. Then you'll see long-term assets and they're all listed. And here they're just kind of mixed together more. It's not that big a deal. But again, current liabilities, this isn't hard to figure out. A lease obligation, rents, that's a liability. Accounts payable. So Krispy Kreme is given, there are other companies extending credit to Krispy Kreme. So not only is Krispy Kreme owed money, so that was under their assets, but they owe money out to, their various suppliers, which makes perfect sense. And then it's interesting here because they have lease obligations, but then they have other long-term obligations and deferred credits, and they're not really breaking that out. So I don't know if those are long-term. It could be, a bank loan, it could be a bond, it could be, a bunch of things. And then the last piece is this shareholder equity. So basically, when you look at the assets and then you look at the liabilities, the difference is this shareholder equity, which is basically just saying equity, right? Like this could be a private company and you would just say equity. It's just like, this is all the good things we've accumulated on our own. But because public companies are owned by their shareholders, it's going to say that it's this equity belongs to the shareholders. And there's all this stuff that goes on in shareholders' equity that's going to sound really confusing, where it says common stock, no par value, blah, 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 blah. And you don't have to worry about it. I mean, the whole par value thing, it has no worth. I mean, when they talk about shareholder equity, they never mention the actual stock price. That has nothing to do with anything. Sometimes par value is $1, sometimes it's a thousandth of a cent or whatever. It's very confusing. It's really meaningless. It's really just, you want to get this excess of there are assets and there are liabilities, and then the excess is this equity. And one thing I wish they had shown here would be like retained earnings, because that's easier for people to wrap their mind around. That, if a company's doing well and it's generating profits and then it's keeping those profits are retained, and those profits are also called earnings. So very often in shareholder equity, you'll see retained earnings, which makes a little bit more sense, that there's been year after year after year of profits, and the company's been keeping it as like a stockpile of assets or money or cash or whatever. And that seems to be a little bit easier to digest. But in any case, hopefully, if we now just take a look, sort of a zoom out and do this piece of the balance sheet, we're starting to feel very comfortable, right? Because we understand our assets, and we can understand the idea that it's great in the annual report. They're going to start showing us, a year-over-year comparison. So, you can start to have some opinions. You can start to wonder, like, well, what is like the book value of this company? Oh, this is kind of interesting. This company, and remember, these numbers are in thousands. So right at the bottom, when it says total assets, it's like $342,875,000 in assets. Well, it's like, okay, well, by the way, that's a really, really small company. I mean, we've got, this is no Amazon. This is no Facebook. This is a nice, sweet little operation where all of the assets of this company, are far less than even $1 billion. So it's just a sweet little company, and you can start having your own opinions about, their cash level, their receivables, definitely looking at inventories. So when you start to feel comfortable and you're wanting to use this information to vet a company, you start to be suspicious. You start to look for things, and inventories is definitely something that people flag. They don't like to see inventories growing and growing and growing. And, in this example, inventory was actually shrinking, which is kind of good. These are the things when you become more comfortable, you will realize, oh, that's good. I'm glad. I'm happy to see that. And if you look at how much like property and equipment is in terms of all the assets, you start to form your own opinions, because you're like, well, I don't know, like if this company ever had trouble, do I really think that they can easily sell their donut making machine, at a fair price? I mean, you just start to have opinions about like, well, what are these assets and do they really matter? And, is this company a good fit for, would I invest in this company? You really will, if you spend some time with it, start to have some opinions. Okay, and then on the liability side, I would say, like, here on the asset side, people really like to see inventories, held at bay, which is good. That's what they're doing. And they're seeing that there's plenty of cash and there's some receivables. There's nothing jumping out at me that looks odd here. And then on the liability side, people definitely look at debt. They definitely look at long-term obligations. And when you get more familiar, you'll start comparing the debt to, like the net income, because like say a company has $10 billion of debt and their net income is less than $1 billion. You're like, wow, in 1 year, like they only earn, it would take them 10 years of earnings to pay off their debt. What do I think about that? Well, that's interesting because in a bankruptcy situation, shareholders don't get anything until all the debt is paid off. So maybe I'm going to be a little debt sensitive. These are the things that people start to look at. And I was a little annoyed with this annual report because they didn't actually add up the liabilities. They kind of just left it floating. So I did it for you. But you can just see, that you're going to have your assets, and then you have your liabilities is much, much, much smaller. And then that leads to the shareholder equity. And so if you have the liabilities plus the shareholder equity, it is balanced with the assets. So that's why it's called the balance sheet. Okay, the income statement. Great stuff. Profit and loss. Let's see what these guys are up to. In a calendar year, what's going on when they pay all their rent obligations, when they buy all their inventory, when they have, pay all their salaries, like how are they doing? And this is this great stuff that you get to see. So we'll zero in because this is still like, kind of hard to take. Okay, so let's just look at the very top of the statement of income, which is like the profit. It is the profit and loss statement. And, no surprise, we're seeing revenues. Okay, that's great. 518 million, almost $519 million in revenue. Great. Let me compare that to the expenses. Oh, 414, million in expenses. And this is everything all in, right? So this is all of the rent, all of the salaries for the cooks and the line workers and the things like that, the janitors, everything. This is the utility bills. This is everything. So you're just getting a snapshot of, okay, when these businesses, all of these stores aggregated together are operating, do they create a profit? And yep, yes, they do. What is interesting, you have the revenue, and then you're comparing it to these operating expenses. And under the direct operating expenses, you see general and administrative expenses. So sometimes that gets confusing, but there are certain functions like accounting, like legal, like human resources. It's almost like the corporate stuff, right? So, maybe they have 1,000 donut stores across the country, and then they have a bunch that are international, and they're aggregating all these businesses, but there's going to be a corporate. And in corporate, that's where you have these general and administrative expenses on top of their direct operating expenses. So again, that's going to be like your accounting and your legal and your HR and your things like that. That's at the corporate level. Depreciation and amortization. If you've never dealt with it before, these are interesting concepts when companies buy, sophisticated equipment, like say they buy a forklift. Because of accounting rules, you don't just take the hit for that, say you buy a fleet of forklifts and it's really expensive. I don't know, say it's $20 million. You're not going to have to bear the weight of that expense all at once, because it wouldn't give you a proper picture of your profit and loss for the year, because obviously you're going to use the forklifts for 10, 12, 15 years. But for whatever reason, you had the cash to buy them all at once. Maybe you issued stock, maybe you issued bonds, and you just, you got a deal and you bought them all at once. Well, general accounting rules say we want to give people a clear picture of, of true profit and loss. And if you're going to use these forklifts for 12, or 15 years, then you're going to slowly depreciate them. So we're going to, or say, for simplicity's sake, we'll just say it's 10 years, right? So say you buy $10 million worth of forklifts over 10 years. Okay, well, what's going to happen is every year for the next 10 years, you're going to deduct $1 million under your depreciation and amortization expense. So, for 10 years, you're going to knock off $1 million. And then after 10 years, you will have tracked the 10 million that you spent on the forklifts. So that's all that's going on with that depreciation and amortization. And it just happens all the time because complex businesses are always buying equipment and doing things like that. And you don't want to take the entire hit for the cost in 1 year, because that would not really be a true reflection of the profit and loss of the company. That gets totally reversed in the statement of cash flows, right? Because, you want to show people what you're really actually doing with your cash, and really $10 million did go out the door in 1 year. So this is when things get kind of interesting, because the consolidated statement of income is telling one story and your statement of cash flows is telling another story, and both stories are true, and they give you a really good snapshot of the business. What is interesting about the statement of cash flows, and what people have an eagle eye for, is did management make a mistake? Maybe this was not the time to buy $10 million worth of forklifts, because maybe they're actually going to be cash poor, and that's very dangerous for a business. In any case, you're looking at the revenues, you're comparing them to the expenses, and you're getting down to this operating income number. And it's a very, very important number. Just, when the business does its core business, this is the kind of profit it's throwing off. Because money can come into the business in other ways, but what you want to see is, like, when they do what they were built to do, make the donuts, sell the coffee, make customers happy, are they making money? And that's what operating income is going to show you. I'm just going to check the chat. Everything looks good. Certainly, if anybody has any questions, just jump right in. Okay. So here, all we're doing is just adding like the extra years. You're just adding some complexity, right? And it's really important to be able to see year over year over year and start to see trends. And certainly no one would be excited about this company if they were a growth investor. I mean, when you're looking at a growth stock, you want to see, growth on a big, big scale. And that operating income number, that bottom line number, is not moving. It's nice, it's fine. Maybe somebody's interested in this company for different reasons. Maybe they think there's going to be a nice dividend or whatever, but this is not a growth story. And that's something that the trend, showing 3 years worth of data will tell you, and that's important. Okay, and so now we have the operating income, and then we start seeing other things that are making the income smaller and smaller and smaller. And that's fine, that always happens. We have income taxes, we have, interest payments that have to be paid on debt and things like that. So you really then get down to this net income total bottom line number of 32,398,000. And again, this is a small business. This is, this is pretty small potatoes, but at least it's a nice way to learn. And when you see the 3 years worth of data, you see this company is just going sideways on its income. It's nice that it has income. It's a nice company. It's not going to win any awards on excitement or growth or any of those things. Okay. Statement of cash flows. I don't know why this just, maybe because people are burned out by the time they get to statement of cash flows, but people just kind of glaze over and I'm done. I don't get it. I don't know what this is. It's really very straightforward. You're going to take the net income number. Okay, so we were just looking at that net income number, right? So at the bottom line here, this net income of 32,398,000, that is the profit. This is what the company is saying was the profit for 2016. But that's not telling you the cash that came into the business and the cash that left the business. They're very different numbers because, right off the bat, you can see we were talking about depreciation. If you are buying equipment and you're spending a ton of money in 1 year and you're depreciating it over 10 years, your books, the income statement and the statement of cash flows look very different. So we got to find out what's going on with this net income. Okay, we were able to book a profit, but what is going on with the cash? And we have to be really careful about the cash. So when you look at the statement of cash flows, they're going to go back to that operating income. And they're going to say, actually, we're going to make some adjustments. If we're just going to talk about cash, we'll start with the net income number, which was our bottom line profit number. But now we have to add back the depreciation because we're depreciating things that were purchased years ago. And they really didn't impact our cash. They didn't impact the cash at all because this was money that was spent years ago. So actually, there's more cash in the business than you would ever sense from the income statement. And then there are also things going on where if some top executives are paid with stock rather than paid with cash, well, that is something that you don't really see it in the income statement. It looks like it's a charge, it's an expense in the income statement, but in the statement of cash flows, you realize there was no cash, right? Issuing stock doesn't create a cash situation. So all that cash has to be added back in. So when you look at the statement of cash flows, they're going to break it down to operating activities, all the things that's really focused on the main business, that making those donuts and making that coffee and paying the employees and paying the rent and all those things. And then you're also going to look at investing activity. So this is back where we can look at, well, okay, the fleet of forklifts. What else were they buying? What other things were going on where they were purchasing property and equipment? And you're going to see the entire cost in 1 year, which we're not going to see on the income statement. And then finally, there's the financing. And the financing is, did they take a bank loan? Did they repurchase stock? That's going to be a cash situation. Did they offer a dividend? So all these things are going on with cash that you're not seeing elsewhere. But then, the good news is you just want to see that there's good cash flow. So, you're starting with this net income number of 32,398,000, and you're looking at all these things that are getting added and all of these things that are getting deducted, and you're seeing like, oh, okay, but still at the end of the day, this is a very cash positive business. And you really want to see that. A lot of people would argue that in the long term, not in the short term, stock prices do all sorts of weird things in the short term. But in the long term, what really moves a stock is what's called its free cash flow. Is this company able to generate cash? Free cash flow. Very similar to what you see here, this cash flow. It's just you actually deduct what are called capital expenditures. So all the property stuff, you can deduct that out because you didn't necessarily have to purchase it in any particular year. So just looking at the free cash flow of the company, a lot of people think that that's the whole ball game. So they really spend time with the cash statement, and hopefully you get some sense of how you can have a good net income number, but a bad cash number. Managers could be making bad decisions, and if you don't have cash, it's game over. If you can't pay your employees, if you can't pay your taxes, you are dead, and you will end up in bankruptcy, and you will need bankruptcy protection, and no shareholder ever wants to see that. Okay, so having looked at all of these financial statements and knowing that someone like a Warren Buffett, pores over these financial statements. He actually says crazy things of like how much he loves reading annual reports and the things that he looks for, that he's looking at these trends and he's looking for consistently higher profit. And he's looking at the expenses that the company is incurring, and he doesn't want high research and development costs, and he doesn't want high the general and administrative expenses that we were looking at when we were talking about how, like, that's the lawyers and the accountants and the HR and the C-suite people and things like that. And he also wants a low ratio of interest payments to income. So he's not a fan of debt. So it's just interesting. This is like how sort of a master investor would pore over these documents. And I definitely look for things as a stock investor, but I'm really interested in anybody out there. You can unmute. Do you want to share? Have you ever really dug into these financial statements, and what do you look for? Anybody want to share their wisdom? You can unmute, you can, if you're shy, you can chat. Is there anything that you in particular look for? And it's fine. It sounds like we have a lot of learners tonight, and not people who maybe have ventured further. I can tell you that I definitely, when I get a hold of these financial statements, and they're very easy to get. Think of any company that you like. You can just Google I don't know, Duke Energy annual report, and it'll probably pop right up. Or pretty much for any company that you're interested in, you can go to that company's website and look for the investor relations button. And once you get there, they should have very easy access to their quarterly statements, their yearly statements. The annual report is sometimes called the 10, I mean, it's always called the 10K, but if you see something that says 10K, you're there. That's the annual report, and it will have these financial statements. And I would say that the number one thing I look for is debt. And I compare debt to the yearly profitability of the company. Because debt's a big deal, and debt doesn't show up in a stock screen. A company can look very profitable, but if they're drowning in debt, you'd only know it by looking at the annual reports. Oh, good. Somebody said something. Let's see. I hear the terms top line and bottom line all the time. What are they exactly? And also, what is EBITDA? Oh, I'm so glad you asked about EBITDA. Okay, let me see if I can find one of the slides that would be the most like top line and bottom line. Let's see. Okay, so here, the stuff that's happening up here is top line stuff. And then the bottom line is just the net income. That's just the bottom line. So if someone's talking about top line stuff, they're probably talking about salaries, cost of inventory, things that are happening at the top of this income statement. And then the bottom line is just whether or not it's making a profit. EBITDA, earnings before interest, taxes, depreciation, amortization. That's a gauge that a lot of people like, because they just like to see the earnings separated from, how would I say? Okay, obviously, like a company can't really affect its how much it's going to have to pay out in taxes. So people who study these things, they like to see the earnings. It's earnings before interest, so interest on debt, taxes, the tax consequences, depreciation, and amortization. So maybe it's just sort of, for some purists, it's like the clearest picture of earnings before you get into all the other stuff of like, well, how much equipment does this company have, and how are they depreciating it, and what are the tax consequences? I hope that's helpful. I mean, it's definitely the people who study these statements are really, really into that particular metric, or getting at that number. I will see if my wonderful book, my favorite dictionary, has an even better explanation of that. And I'm really glad you brought that up, because you will definitely hear that all the time. Doesn't even cover it. Terrible. All right. Okay, now let's see what else. If the financial statements are only 3 pages, why is the annual report 136 pages? The annual reports are fascinating, and really, because of SEC rules, companies have to disclose every imaginable risk factor. So if you read the Krispy Kreme annual report thoroughly, and if anybody wants to, I will email it to you. It is 136 pages. They talk about risk factors like currencies, right? So currency fluctuations can be a risk factor. Krispy Kreme at that point in 2016 didn't have a huge footprint outside of the United States and Canada, but again, they have to go through every possible thing that could go wrong. Commodity prices are another huge factor, right? If you're like in this business of, where you need wheat, you need to make flour, you need coffee, you have these commodities. Well, if all of a sudden the cost of coffee goes through the roof, that's a risk factor because you maybe can't pass along the increased cost to your customers immediately. So these financial statements are really weighted down with lots of explanation of risk factors. And also just if you go through an annual report, it will explain to you all the different things that they're depreciating and amortizing and go in depth more on their receivables and things like that. So they really walk you through almost line by line everything that they're explaining. They talk about their strategy for the business. There's a lot of marketing that goes into the annual report of trying to put the best possible spin on things. They talk about the industry they're in and what are the challenges for the industry. It's very, very dense. Let me just check this chat one more time. And maybe somebody did a better. Oh, did you do this, Young? EBITDA.
Yes, I did. Yeah.
Oh, so helpful, so helpful. EBITDA, or earnings before interest, taxes, depreciation, amortization, is an alternate measure of profitability to net income. By stripping out the non-cash depreciation and amortization expense, as well as taxes and debt costs dependent on the capital structure, EBITDA attempts to represent cash profit generated by the company's operations. Well done. Yes, thank you so much.
You're welcome. There's another question here.
Oh, okay.
How do you calculate the EPS, earning per share?
Oh, that's separate. So that's not in the annual report. So no, I don't think they do that. So, but that is definitely something you will see in a stock screen. So if you say a company issues stock, right, and say they issued I don't know, 1 million shares. We'll make this simple because companies issue 500 million shares. But say a company issues 1 million shares, so there are 1 million shares outstanding, and then the earnings for that company just happen to be $1 million, right? So there are 1 million shares outstanding, and the net earnings is $1 million. So that's basically like $1 per share. So that's your overall earnings divided by the number of shares outstanding. So your earnings per share. And when people then look at like a price to earnings ratio, they're looking at the price of the stock. So say the stock is $10, right? And the earnings is $1 per share. Well, now you have a PE ratio of 10. And people who, once you get familiar with these things, like if you see a PE ratio of 45, you go, wow, that's like really high. That's an expensive stock. But if you see a PE ratio of 7, you go, oh, wow, that's really low. You're not actually spending a lot to get significant earnings. So if you do this over and over again, you just kind of get a feel for it. And then you see things that are like outrageous. I mean, Amazon has been clobbered recently and their PE is still in the 90s. I mean, some companies are really, really expensive, and expensive in the sense that they have a high price to earnings ratio. And if a company is new and has really interesting technology and might be innovative, might be disruptive, might be the wave of the future, then people don't mind a very high PE because they go like, well, yeah, but they're going to grow. That PE is going to go lower because the earnings are going to skyrocket. And so, but if it's a company like Krispy Kreme, you want to see a low PE because we've already seen from the financial statements that this company is not growing. At this company, we're looking at an annual report from 2016, which we had to do because then the company went private and had no annual reports, and then it came out public again. But anyway, but the company wasn't growing. So you would want a very modest PE for a company like this. Good, solid company, but not any record breaker. Okay. Let me see. Is the Bloomberg terminal at the library that much better than something like Yahoo? That's a really good question. I think Bloomberg's terminals are unbelievably awesome, but I wouldn't even know how to navigate it. Young, does somebody show, if you go to the library, does someone help you use the Bloomberg terminal?
Sorry, the answer is no, because Bloomberg is for financial professionals. So library does not provide any technical support. We usually do 2 training per year. We have the Bloomberg, trainer to do it twice a year, one in February, one in November. But we did that even in the COVID, but for this year, the representative working for our account, she quit. And they haven't assigned new people. I've been contacting them for 2 months. They did one in February, but they haven't done anything. I want them to do one in November, but they haven't assigned anyone yet. They haven't assigned people to work and take care of this account yet. That's
wow.
surprising. Usually their customer service is really good, but not this time. I can be contacting them for 2 months. They haven't assigned anyone to take care of this account yet.
So I know it's getting late. I maybe Young, if that ever gets resolved, you might want to do an email blast to anybody who's part of the investing group, has done any of that stuff, because I'm sure they'd be interested in a training.
If there's a training, I'll email to I'll post it on our calendar, and I'll email to all the people who registered for the investment group.
Yeah,
And
I'd
also
like to
for
do
today,
it.
yeah, and also for today's program, we recorded already. And then, a couple of days later, our PR will post today's recording on the library's YouTube channel. So a few days, I'll send you an email when it's ready. So it will be Greenwich Library YouTube channel, today's program.
Perfect.
Anything you want to add today?
Yeah, I just want to say, there's a book at the library, Financial Statements for Non-Financial People, that is fantastic. So definitely use that as a resource. The next session of the investing group is December 13th on a great topic, what your financial advisor isn't telling you. So definitely register online for that. Financial advisors can be great, but there's a lot that they miss, especially with what goes on with your HR department, what your decisions you're making tax-wise. So you definitely want to see that next session. And again, email me, kjacks@moneyinyour20s.com, if you would like that tax chapter. And I think that's it. Unless Young, anything else you want to add?
No, just thank you everyone for coming, and please remember to sign up for the next session.
Okay.
I'll email you when the video is ready. Thank you very much. Thank you,
Bye,
Kristen.
everyone. Thank
Bye-bye.
you. Bye.